If you've ever gone looking for a Forex broker, you've seen all the terms, right? A-book, B-book, ECN, STP. It's kind of confusing, and honestly, brokers often use this stuff to make it sound like you're getting this super direct pipeline to the market. But what's really going on behind the curtain when you click that buy or sell button? All right, let's dig in and really pull back the layers on how this all works.
So let's just start with the biggest question of all. When you place a trade, you probably picture your order just zipping through your broker's system and landing right in the middle of the huge global Forex market. I mean, that's what the marketing wants you to think, isn't it?
But here's the thing. The reality is, well, it's a lot more complicated than that. For pretty much all retail brokers, the answer is actually a surprising no. Your order doesn't just go to the market in the way you might imagine.
And that leads us right into our first major point. This whole marketing myth that's been built up around the term STP, which stands for straight-through processing. This term, it's been stretched so far from what it originally meant.
And look, this isn't just my opinion. This quote right here really nails it. The industry itself knows that the term STP has basically been hijacked for marketing. It's been twisted to create a meaning that sounds great to traders, but isn't the whole story.
Let's just get this straight. Back in the day, STP just meant that a trade was processed by computers without a human having to type it in manually. That's it. But now it's used to paint this picture that your order is flying straight to the market. The truth, your broker is always your one and only counterparty. They are on the other side of your trade. Your order never, ever leaves their system to go to some external market.
Okay, so if your broker isn't sending your order straight through, then what are they doing with it? Well, they're managing their risk. And they do this using two main methods, which get confused all the time but are totally different: A-book and the real STP execution. You know, the entire difference between these two models, it all boils down to one simple thing: timing. With an A-book model, the broker fills your order first, and then they hedge their own risk afterward. But in an STP model, they do the opposite. They hedge their risk first, and then they fill your order. Let's see what that actually looks like.
So let's actually walk in and order through each of these models to see exactly how they tick. This is where it all really starts to make sense.
First up, let's look at the A-book model. So you send your order, right? Now look at the diagram. See how the broker immediately sends a confirmation right back to you? They deal with you first, locking in your trade before they do anything else.
So here's the play-by-play. 1, you send the order. 2, bam, the broker fills it for you right away, confirming your price. It's only after your trade is done and dusted that the broker, on their own time, turns around and places the exact same trade with their partner, a liquidity provider, to get that risk off their own books. This is what we call post-trade hedging.
All right, now let's look at the STP flow. See the difference? When you send your order to the broker, they don't immediately confirm it with you. Nope. Instead, their first move is to go out and talk to their liquidity provider. In this model, you send your order, but hold on. Instead of filling it, the broker first sends an identical order out to their LP. Then, the LP confirms a price back to your broker, and it's only then, after all that, that the broker finally executes your trade at whatever price they just got. This is pre-trade hedging. They lock in their side of the deal before they lock in yours.
So, why on earth does this matter? Who cares about the order of operations? Well, you should. Because this one key difference has a huge impact on your trading experience, especially when it comes to execution speed and this little thing called slippage.
Before we go any further, let's just make sure we're all on the same page about slippage. It's that annoying moment when you click to trade at, say, 1.2000, but by the time the trade actually goes through, the market moved, and you get filled at 1.2001. It's just the difference between the price you expected and the price you actually got. This table just lays it all out, crystal clear. Because an A-book broker confirms your trade instantly, the execution is way faster, and your chance of getting slippage is super low. But with STP, that extra step of going to the LP first, well, that makes the execution slower, and it seriously increases the probability of slippage. So, the root cause of slippage in that STP model is simply that tiny delay. In that fraction of a second while your broker is waiting to hear back from their liquidity provider, the market can wiggle. And if it does, that new price is the one you're stuck with.
So if STP is slower and it has more slippage, why would a broker ever use it? That's a fantastic question. And it really comes down to their business model. It lets them operate as something called a riskless principal.
Here's how it works. You trade with your broker, yes, but at the exact same time, your broker makes an identical but opposite trade with a big liquidity provider. They're basically just standing in the middle, acting as a go-between, without taking on any of the actual market risk from your trade.
It's kind of wild when you think about it. When you place one order, you're actually kicking off two identical back-to-back trades. The first one is between you and your broker, and the second one is between your broker and their LP. Since these two trades perfectly cancel each other out, the broker is left with zero risk. That's why it's called a riskless or matched principal transaction.
And this right here is a huge takeaway for a lot of traders. In this model, the broker's profit does not come from you losing money. Instead, they make their cash by adding a tiny, disclosed markup to the price they get from the LP or by charging you a straight commission. Their interests aren't directly against yours.
Okay, we have covered a ton of ground, from marketing myths to the nuts and bolts of how trades actually work. So let's bring it all home and talk about what this really means for you, the trader.
So here's the bottom line. First, just ignore the marketing jargon like STP. The real question you should ask is when your broker hedges. A-book means they hedge after your trade, which gets you faster execution and way less slippage. STP means they hedge before your trade. It's slower, yeah, and you might see more slippage, but it creates a model where they aren't directly winning when you lose. If you can figure out which model your broker uses, you'll understand so much more about the trading conditions you're going to get.
And all of this leaves us with one final big question. There's a really clear trade-off here, isn't there? Do you want to prioritize lightning-fast execution and minimal slippage? Or do you prefer a model where you know for sure that your broker doesn't have a direct financial stake in whether your trade wins or loses? Knowing what you know now, which one of those models feels right for your trading style?